Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.
Hello and welcome to Inside Options. I'm Jane VG. As usual, joining me is James Boardman from the JSE's Equities Derivatives Division. James, welcome.
Hi, Jane.
Today we're going to get quite technical, aren't we? We're looking at a particular financial model. So we're really getting stuck into the actual how to trade options, aren't we?
Absolutely. We're going to be looking for most of the episode at the Black-Scholes model. You would think this could be pretty boring, just talking about a financial model for 15 minutes. In fact, it's quite a fascinating story involving a Nobel Prize for economics and a multi-billion-dollar bailout. So we're going to be talking a little bit more about that.
All right, so we're not going back to ancient Greece this time round,
no, much more recent.
Right. Okay, so where does this all start?
It starts in 1973 when Myron Scholes and Fisher Black published a paper about option pricing. Now, coincidentally, this was the same year that the Chicago Board Options Exchange was founded. So it's a strange coincidence. It only came out sort of a month after the exchange had been founded, and it caused a sensation around the world, with traders sort of saying this is a really nice way of pricing options. Before that, it had been quite esoteric, quite complicated. You needed quite experienced guys to do it properly. Now anyone with a spreadsheet, including you guys at home, can use it quite easily.
Okay, so what to? So we've got a graph that we need to look at.
Yes, we do.
Okay.
If we could switch to that graph, we can see the growth in options trading. It's up here on the plasma. Mm-hmm. And you can see that by 2006 there were 2 billion options contracts traded from the Options Clearing Corporation's data. Now in 2010 they traded 3.9 billion contracts. Now you think each one of those is on usually 100 or 1,000 shares. That is a lot of volume going through the US options markets. And I think a big part of it has been the Black-Scholes model. Sadly, by 1997, when these guys won the Nobel Prize, Fisher Black had passed away. He was one of the main creators. He's the Black in the Black-Scholes model.
He wasn't around, unfortunately, to take some.
He wasn't around to get the credit, because you don't get posthumous Nobel Prizes. They did mention him in the citation. It was actually given to Robert Merton, who did some extra pricing work that was very, very useful, and to Myron Scholes. Okay. So they got this Nobel Economic Prize. Interestingly enough, Fisher Black worked at Goldman Sachs, and this is quite a fun book called My Life as a Quant by Emmanuel Derman, and he worked with Fisher Black at Goldman Sachs. And it's quite interesting because he's South African, and he now runs a hedge fund in New York and is very, very successful.
Right.
Here we go. This is a picture of Myron Scholes and Fisher Black and Robert Merton, and there's the Nobel Prize in economics that they won.
So how did this all sort of transpire? I know that 1997 was then a key moment for the Asian crisis.
Slightly before they'd got the Nobel Prize, Myron Scholes and Robert Merton were involved in a hedge fund called Long-Term Capital Management. They were founding partners of it. It took a lot of bets using various option pricing models, betting that risk around the world would decrease. As we saw in 1997, 1998, it really didn't. It exploded with the Asian currency crisis and then with the Russian debt default. Interest rates in South Africa actually went up to 20%. So these guys really got caught out very badly then.
So what happened then?
You can see here, this is what happened. In 1994, when they started, if you invested $1, it would have turned into $4 by 1998. Then suddenly, you can just see it just fell off a cliff. They had massive, massive leverage. They were leveraged something like 35 or 40 times to 1. So when some of their bets went wrong, they lost an absolute fortune. It kind of goes to show that despite these guys being the smartest guys in the world of finance, over-reliance on these mathematical models without using some common sense and fundamental analysis, and using too much gearing, you can get into quite a lot of trouble. So the markets can be... Yes, they were bailed out. It was a fascinating story. You can read about it in another book called When Genius Failed by Roger Loewenstein. They had bets with so many people around the world, these big positions, and so much leverage that they decided they had to bail them out to save the world's economy. So these guys got a bailout and emerged sort of okay, but the investors in the fund didn't do very well.
All right, well, it sounds like we're hanging on the edge of a cliff here. When does the good news start, and how do we start doing some positive trading?
The good news is that this Black-Scholes model is incredibly useful, and pretty easy to use using simple spreadsheets. We've actually got one you can download on the web on our JSE website.
And I think we can also see it at the bottom
you
of our screen.
You can see it at the bottom of our
yes.
screen.
Right.
Yeah.
Okay, so let's take us through this, James.
So the main insight in their model was not actually the maths in the model. And that was already relatively well known. It was the insight that by using that maths, any option could be broken down into a combination of stock and risk-free government bonds. This meant that you could synthetically replicate an option using a combination of stocks and bonds. It's important to note that this is a dynamic hedge, so it changes all the time and you have to change the ratio. That ratio is called delta, and we're actually going to have an episode, I think our next episode, we're going to talk about delta quite a lot. You'll come to understand a little bit more about what we mean by this. But over time, you're buying and selling stock and reinvesting the money, and by doing that, you're hedged. So what they worked out was that you didn't need to work out the price of an option. You needed to work out what the cost of hedging it was. You can hedge it with this combination, and buying and selling over a daily basis as the price moves is going to have an impact on your profit and loss. That difference in buying and selling works out to be the cost of that option. That is then the Black-Scholes price.
Right.
Using this method of no arbitrage pricing, you can hedge even the most complex of derivatives because you just have to hedge the risk. You don't have to hedge the actual thing, which could be a bundle of all sorts of options with a complicated payoff. And that works for pricing just about everything.
Okay, where to now?
So, because this model really simplified things, it brought it all down to just one number that became really crucial in option pricing. There are quite a few inputs into the model, and they include sort of risk-free rates, interest rates, dividend yields, your forward prices. Those are all fairly standard, and you can find them on sort of any good financial data source. The number where it gets tricky is implied volatility. Implied volatility is a forecast of how volatile a stock will be. It's a forecast of how much and how frequently the speed of change over a forecasted period. So generally this is quoted as an annualized number and as a percent. So you get sort of 20%, 30%, and that has a massive impact on the price, because the higher the volatility, the more frequently and the larger the amounts of stock and bonds you're going to have to reshuffle in your portfolio. And as we've seen, it's those reshuffles that cost you money. So the higher that is, the more outlandish an event you have to have happen, and the more unexpected it has to be to end up profiting from an option.
All right, great. James, we're going to leave it there for a second, because after the break we are going to come back and we're going to be looking at an actual example, I believe, on a spreadsheet.
Absolutely.
So do stay tuned. We'll be right back.